this is the area that I think just separates people who have success with this types of strategies and those who don't. Just because you have a systematic process, you're still a human being, and we still have to operate these things and do it. And it's like those who I've seen be successful over time are the ones that just didn't quit or deviate from, that what was otherwise a good process. It just was going through a short-term performance period that didn't give you positive feedback.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome to another episode in the Open Interest series on Top Traders Unplugged, hosted by Moritz Seibert. In life, as well as in trading, maintaining a spirit of curiosity and open-mindedness is key, and this is precisely what the Open Interest series is all about. Join Moritz as he engages in candid conversations with seasoned professionals from around the globe to uncover their insights, successes, and failures, offering you a unique perspective on the investment landscape. So with no further ado, please enjoy the conversation.
Hello everyone, and welcome to episode number 9 of the Open Interest series on Top Traders Unplugged. My name is Moritz Seibert, and today on the podcast I have Cole Wilcox from Longboard Asset Management. Longboard Asset Management is an Arizona-based mutual fund manager whose main focus is on systematic single stock trend following strategies, and Cole is the company's CEO. And I guess congratulations are in order, as the firm has recently celebrated its 20-year anniversary. So what is it that we'll do today? We'll speak about, single stock trend following, the performance of single stock trend following more generally, the differences compared to equity index trend following, where the alpha compared to a buy and hold equity investment comes from, and some of the potential challenges for the strategy. But let me move the ball over right to Cole. Cole, welcome to Open Interest. Thanks for joining me today for what I think will be a very interesting conversation.
Thanks, Moritz, for having me, and I'm excited for the conversation. This should be fun.
It should be fun, absolutely. So 20 years, I've just mentioned it, the 20-year anniversary of Longboard Asset Management, which means you've been at it for a long time. Take us down memory lane. How did it all start? Single stock trend following is not something that, you're not the only one doing it, but it's not completely mainstream either, especially not 20 years ago. So what was the origin of the idea? How did it all start? And how did you become interested in single stock trend following in, the early 2000s?
So originally, and when I got into the investment management business, it was a brief stint as a stockbroker, which started in 1997. And so for those first few years, I obviously had a pretty familiarity with the stock market. Quickly realized that wasn't a career path I wanted to go down, and I pivoted into the hedge fund industry. And the position that I had there was as the chief investment officer and kind of overseeing a multi-manager pool that allocated out to hedge funds. That firm had a specific focus and interest on managed futures, trend following, macro type strategies. So I would do due diligence on both discretionary and systematic managers, and became kind of an expert for a number of years in that space. And what we realized in talking about it is we had this equity background. It's like, how come trend following, which was such a dominant kind of philosophy for a lot of these managers in the space, wasn't being applied to like a better equity mousetrap. And at that time, this was we were fresh off of the 2000 to 2002 tech wreck kind of scenario. The market was down 50%. There was a lot of pain, and kind of asking, like, there's got to be a better way of equity investing that had the upside, but a way to manage the downside risk. And so when we would talk with these managers in this space, it just was like futures and equities just seemed to be like oil and water. They just weren't the same worlds. If you were an equity guy, you were fundamental. If you were a CTA, you were doing trend on futures only. And this like trend on stocks just was not something that anybody was thinking about. So we decided to kind of do the research there and, see what it said. And that ultimately is what led to the publication of our papers, does trend following work on stocks, and the follow-up papers about the capitalism distribution and the distribution of winners and losers, and kind of the power law of return distributions in individual stocks.
Right. So it sounds like you designed, or you were set out to design a solution, a better solution for equity investing, as opposed to creating a diversified CTA. I mean, most, CTA trend following traders, they would trade bonds and currencies and commodities, all sorts of commodities, in addition to equity indices, or even equity indices and single stocks. But you decided to not trade these other asset classes, but specifically focus on the equity components, I presume because there was a demand for that, or that was the niche that you were looking to build out.
I don't know if there was a demand for it. I mean, maybe we thought there would be a demand for it because there was so much risk. I mean, if you back up, why do people add CTAs or managed futures into the portfolio? CTAs and managed futures are always a minority kind of token allocation. Maybe it's 5 or 10% in a portfolio. The rest of it's very dominated by the risk from equities. And, so because equities are risky and they're volatile, investors are seeking non-correlated return streams. And that's where the demand for managed futures comes from. And we said, well, what if you could just directly reduce the volatility of equity investing and the risk of equity investing, but still keep the returns? And then you didn't have to go to this completely different strategy or these other asset classes in order to get what you wanted, which was lower risk, lower drawdowns, a smoother ride from your investment portfolio. So that's kind of the direction. Like managed futures and globally diversified portfolios and systematic trend, they're really optimizing for low correlation in the portfolio. I mean, that's why the product is purchased. Probably low correlation, and the ability to maybe make money in a really big crisis events if you happen to be on the right side of the trade. We're not trying to optimize for low correlation per se. We're trying to optimize for lower risk investing, lower drawdown investing without sacrificing what you would otherwise get as being an equity investor.
Keeping the losses small and letting the winners run, I guess, that works pretty much everywhere, including the single stocks. So let's take a little bit of a deeper dive into the strategy itself. In our pre-call call, you mentioned that your universe is the Russell 3000. And specifically there, I think, if I remember that correctly, you remove the top 100 large cap stocks, essentially the kind of like S&P 100 component from that universe, so that you're left with a more centric allocation in the mid caps and the small caps. Is that a fair summary? And if so, why do you do that?
Yeah, I mean, that's a fair summary. We do eliminate the top 50th percentile of market cap, which eliminates roughly the S&P 100. We also eliminate securities that are just too illiquid, to trade. So a lot of stocks on the micro cap side of it get filtered out as well. I would say roughly on average, our portfolio investable universe is, in the 2,500-ish stocks that would be like active and live at any given time that we could potentially capture a trade from.
Right. And then it follows systematic rules. You have whatever, like a breakout or whatever method you're using, some form of price trend detection. And then you get into that stock. I presume you put an equal amount of risk or an equal amount of risk allocation into each of these trades. And you just let it run in the same way that most other, say, diversified trend CTA traders would size their trades and let them run until the point comes where either the stop is hit or the exit level is selected.
Yeah, that's all true. I would say if you looked at the underlying logic of what it is that we do for entry, for exit, for risk allocation, sizing of trades, things like that, that's all pretty much what you would expect from looking at any kind of long-term trend following investment process that somebody in this, there's a lot of different ways to do trend and whatnot, but ultimately that's what it is that we're doing.
When you look at the, say, alpha or the outperformance or let's say the key return driver for the overall strategy, is it that you have, reduced losses, small losses, and a potentially unlimited upside? Or would you say there's also a lot of alpha coming from the fact that because your universe is so much larger, you've essentially broken up the equity basket into its 2,500 component parts, and there's more idiosyncratic behavior going on in that basket, more crazy outlier trades in both tails of the distribution, but you can catch more of these outliers in the right on the right side of that distribution, given that I think we haven't mentioned it yet, but you are long neutral, you're not trading the short side. So is what you say, is it both equally, or is one dominant over the other? Is it more like these massive outlier right tail events where some of these stocks go to the moon, or is it more like you avoid the failures and the unforced errors by immediately removing or quickly removing larger losses from the portfolio?
I would say it's a combination of all of the above to different degrees. So, the biggest one, most people in life tend to focus on picking winners and trying to find the next, big thing. And there's an enormous amount of industry research that goes around trying to figure out what's gonna work in the future. What we have found is that kind of Charlie Munger has this quote about always invert. So, we kind of look at stuff the other way and say, well, let's study the failure. And so one of the insights that we had when we published the research called the capitalism distribution, and then a super famous paper by Hank Bessembinder followed up on this work, kind of looked at the success failure distribution of the stock market over time. And most stocks are very, very bad, investments. 96% of companies that have ever been public generated returns that were worse than T-bills collectively. And the remaining 4% are responsible for 100% of the stock market's wealth creation over the past 100 years. So, this is not a bell curve distribution of success and failure. It's a very much winner take all kind of system in the stock market, which means your odds of picking winners is pretty low, right? Your odds of owning a loser or something that's average to below average are quite high. So where a lot of the alpha comes from in doing this is more on the removing the vast majority of things that are subpar to bad investments while still having the discipline to, because you're catching every trend, to own those winners, into the future. So it's just in our universe, in that Russell 2500, or say the Russell 2000 specifically with the small caps, I think right now maybe 40% or more of those companies are unprofitable and don't make money. There's just a lot of not very good businesses, kind of out there that are public companies, and avoiding, investments and just not good businesses is a way to get a hit relative to an index that just kind of owns everything. So I find that avoiding the losers is a big factor, while still having a system that assures you that since you've covered everything in the market, you're going to own all those big winners. Those are two big advantages on the stock selection kind of level. But then there's a second component that gives us an advantage to any traditional long-only investor. That is that as a trend-following strategy, we're running, risk management. So a long-only investor has no systematic market downside risk protection. It's just going to accept whatever the beta moves of the market are. we're actively managing risk on the downside, actively managing and controlling drawdowns. So in addition to having this kind of stock selection alpha winner and loser, you're also cutting the systematic risk on the downside. And when you roll all of that up, you get a portfolio that has much lower beta than the market, lower risk, lower volatility, lower drawdowns, but is still outperforms its benchmark, kind of index in terms of the aggregate long-term compounded returns from it.
Two follow-up questions on that, and thanks for this. I mean, one is if you compare your portfolio allocation at the end of the day and your weightings, I presume it's going to be more equally spread across all of these names because you don't necessarily have a preference for one name over the other, which means you're not top heavy in the Magnificent Seven or any of these, tech stocks. So you're not market cap weighted. And that kind of like removes, I would say, probably a big portion of the correlation that you would have to the beta 1 equity space. And then second, the way you've just described the, 96% of all stocks aren't really great performers. There's a lot of drag by, simply owning all of them. Obviously, immediately you think, well, you should be trading the short side of that in order to take advantage of these 96 that, don't make it or don't really produce a lot of return, or possibly follow some of them down to zero. So maybe you can comment on these two things.
I'll comment on the first one, then you have to remind me of the second, or vice versa. The shorting part of it. So there is a lot of opportunity to create short strategies that can be a good hedge, lower the equity beta, those kinds of things. It's certainly there for products and different kinds of things. Our particular strategy is very much formulated for the needs of our investor base. And they're really looking to kind of swap equity beta for something that can just be lower risk, but without taking a tremendous amount of tracking error relative to that equity beta. So when you move to a pure long short strategy or a market neutral type situation where you're trying to isolate the alpha from the beta and just create something that is there, it's a different product that has different correlation properties, has different tracking error kind of issues, and it's not the return stream that our investors want that serves there. For a different investor base that has different priorities and needs, you certainly can layer in the short side to things and create a different thing. It's just not what our investor base desires.
The other one was getting the exposure more equally spread across these 2,500 names and not being market cap weighted and therefore top heavy in, some of the largest. I mean, right now it's tech names. 20 years ago, it used to be, energy companies or whatever it was. So you're more like an equally weighted or equally risk weighted allocation to the equity space. Wouldn't that break up some of the correlation in the beta that you have to the overall market already?
It does. I mean, we do have a lower correlation, or relatively lower correlation, to the market. And that's true. So relative to long only investing, we are low correlation. But relative to, say, managed futures, right, or gold, or some other truly uncorrelated, statistically uncorrelated property, we're not. So relatively speaking to other long-only equities, yes, you would find our correlation to be very low. But we would not be very low compared to the lowest correlation or correlation of zero other types of alternative strategies.
As we're speaking about this, I mean, what is your correlation to the S&P 500, say, roughly?
You're kind of in like the 0.55 zone.
Okay, that's actually relatively low, lower than I would have thought. Now, U.S. stocks, you're looking at U.S. stocks only. Was that kind of like by design, or was it a demand-driven, like you're building that product as a solution for your clients, for advisors, and, given that you're in the States, they look at U.S. stocks predominantly. But you could have made the decision to also include stocks from other countries and use the same method on a more internationally diversified basket to potentially have an even better outcome. Did you ever run tests on that?
Yes. So I've tested the strategy on international stocks and other places. It's just as effective. It just really comes down to, again, the product design or the strategy design for the preferences of your investors. In our case, our clients are U.S. financial advisors, and they're using us to fulfill their equity mandate or their alternative equity mandates in the portfolio, and those are dominated by U.S. equity holdings. International securities and things like that actually represent a fairly small portion of the aggregate, kind of money that's out there to allocate from U.S.-based financial advisors. I think if I was in a different country and my investors, preferred to own those domestic securities inside that country, I would do things differently. But it's certainly not because it doesn't work. I mean, this is a universally applicable strategy that works across market capitalizations, works across countries. The distribution, that power law distribution of stocks of winner take all, a minority are going to make really all of the wealth and the rest are going to be not good, is a universal mathematical law of capital markets.
Sounds like everybody that trades equity index futures on the trend side should really be motivated to break up that basket and go into the single names.
I mean, there's opportunity there. I think that for those who are doing trend following on indexes, I mean, a lot of the value of trend is being extracted from trading indexes, like because you're cutting out the left tail, right, of the really catastrophic down movements of the market just by trend following. I think, where we really find a significant edge for us, though, it is in the area of the, small cap, mid cap spectrum. Like that's going to be very underrepresented in any kind of like equity indexes or equity futures based portfolios of stuff. If you're trading a portfolio of equity index futures and you're doing trend on them, you're going to be dominated by indexes that are large cap by nature, even if it's a globally diversified, kind of portfolio. And this opportunity set that we participate in the small and mid cap, spectrum is just not going to be appropriately represented by that index, exposure. And then when you are doing it, let's say you trade the Russell 2000, which has index futures on it, it's a horribly inefficient index, so unpacking that area where there is inefficiency with inside of it is certainly, opportunistic. The thing that you lose, I would say that maybe any futures people probably don't like or could be a part of it is obviously it's not a futures contract, so you're paying full cash, for things. So there's some funding issues, right? That it wouldn't work maybe in a levered portfolio context the way that managed futures tends to be. You got to pay up for the cash equity part of it versus getting a derivative kind of thing that you're getting through the futures contract. But for us, I find the philosophy of trend applied to what it is we do to have been highly effective and produces results that can add a lot of value by mixing in this type of equity trend into your other equity portfolios by reducing risk, giving you a different, kind of stock selection types, things that you own relative to other stuff, and just can play a very powerful role to diversify investor portfolios.
Let's maybe speak about some of these more technical details of trading, if you don't mind. You've just mentioned the funding piece. I don't know whether you fully fund all the cash securities that you're long or whether you trade them on margin, which, you could, and, therefore you would also have a leverage component to it. Do you fully fund every single name that you have in the portfolio?
Yes, we fully fund every name in the portfolio. And this is an unleveraged strategy, right? So it doesn't use leverage with inside of the fund. We could run it right at a higher level of risk and use leverage, but in our product and our strategy and our fund, we do not.
And would you many trend following traders, they would use a volatility measure or like an average to range or something like that to determine position sizes. So then therefore, if you have, some names which have very low volatility, you would size them larger vis-a-vis the names that have higher volatility, they would have a smaller position size. But every time you do that, especially in periods of very low volatility, you could end up with leverage where you need actually to invest more than the $100 that you have in order to get to the exposure that you want. So in that case, you wouldn't be able to fully fund. You would need to get some borrow or some loan, marginal loan to trade. But do you kind of like cap it at 100 and cap the allocation there for the portfolio?
Yeah, we do to prevent it from scaling up, kind of higher. In our case, the risk target that we have in the portfolio. So what you've described in terms of, risk weighting the positions and then having that sum up to a level of like target risk in the portfolio is exactly what we do. And obviously your positions are moving around, volatility is moving around, new positions are coming in and out. So there's a constant process of rebalancing the positions across the portfolio. I mean, we have a large portfolio on average. Small relative to the universe that we trade, but it has hundreds of stocks in it at any given time. And we're constantly making rebalance trades to kind of calibrate the risk, in the portfolio to where it needs to be. And we do have a cap, on it can't scale up and start using, leverage in the portfolio. For us, though, that's not really an issue because the underlying volatility of the positions that we trade or are investing into are the highest volatility segment of the equity markets, like small and mid-cap stocks are much more volatile than S&P 100 stocks. And so we tend to really get to our full risk target without ever using excess, one-to-one exposure. So that's another kind of factor for us. You really wouldn't see a situation where it's saying, oh, you should be 2x leverage on this level of risk in the portfolio, because the amount of volatility that would have to compress to have that happen would be not historically happened before. And also, if it did, I would say, well, this is just a very risky trade, kind of thing. So you're just levering up and just putting on tons of notional exposure. That just is a recipe for disaster, which we would not do.
Yeah, got it. You're more likely to belong the SMCI stock than Coca-Cola, and SMCI has higher volatility, or any of these small and mid-cap names have higher volatility than Coca-Cola and the big names. And therefore you have less of a size on there. You've also mentioned rebalancing trades. I mean, I guess, and you said you essentially do them all the time. I presume that has also to do with dividends. With such a large portfolio, you get dividends daily, I'd say, or very often in the US. Do you then immediately put that money back to work in the portfolio and you spread it across all the long positions that you have?
Yeah. So, that's probably why a lot of people don't, do this. Like the dividends, it's not just dividends, corporate actions, mergers, buyouts, spinoffs. There's just a lot of ongoing things, right, that happen that you have to kind of deal with, in this world. For us, all of those cash flows come in and they just get added back to the base trading level, right? And then it's going to get dispersed proportionally throughout the portfolio for size. So we don't, if you get a dividend distribution, we don't take the cash from it and then go rebuy that specific stock. It's just adds it into the cash balances of the portfolio.
Right. And maybe just to sum that up, and do you loan out stock? I mean, that could be another source of income, is to, say, okay, here is all these 2,500 stocks. There are people out there, I guess, who want to short them, especially some of these small and mid-cap names, and you could make some nice borrow income by doing that.
Yeah, it's something that we've evaluated, before, and our, the current status on stuff about it is, yes, we could, and there is some de minimis amount of potential additional income that could come in from it. It's not without risk. You are loaning your shares away, you're taking on some form of counterparty risk and rehypothecation risk from it. it adds a different degree of complexity to things. And when we evaluated kind of what's the upside, downside, for doing this, the extra complexity for the amount of residual income that we kind of said, like, for us, like, the juice just isn't worth the squeeze. And even though it may be an infinitesimally small amount of counterparty risk, it's not something you're getting paid for proportionally. So that's not, harmonious with our kind of philosophy to take risks that you don't really get paid for.
Fair enough. Back in the day when the Von Chicago exchange existed with the single stock futures, did you ever trade there? Did you find that efficient, or was there just never anything that you had to look at?
So in the brief time that it existed, we looked at it. There was never any need for us to use futures. It definitely limited the universe, right? So that's the problem. And then also those stocks would have been the larger cap names, the more liquid, stuff. So that wasn't ever really an option for this area that we find is just much more fruitful for trend following. The small mid cap sector has disproportionate outlier movements relative to large cap stocks. That has also disproportionate amounts of failure, as well. So it cuts both ways. It's not just a freebie. But if you have a process like ours where you're able to cut your losers without having to know what the loser is going to be in the future, and you can just hold on to the winners, it's a really great place to be applying this kind of strategy that actually produces real alpha and excess return with inside of it. Like, there's a lower failure rate with large cap stocks, so the effectiveness of cutting risk, is not as good with S&P 100 as an example. How often, like, you may sometimes get a large failure like Enron that goes to zero in a year back in the day, or some fraud. It's very infrequent that happens. But in the small mid cap world, it happens all the time. So there's a lot of value in being able to remove that stuff from the portfolio. There's also 10, 20, 50 baggers that come out of the small and mid cap, kind of zone that you can make, a lot of money from, that you're not going to find that same kind of gains that happen from a universe that's just the S&P 100.
Cole, on average, what would you say? How many names do you have in the portfolio on the long side?
We're trying to really just own the cream of the market. It depends on the breadth of what's happening, that how many names that we've got, but it's between 300 to 600 names, I would say, is kind of like on average, maybe 20% of that investable, tradable universe is like what we own. And then the other 80%, we don't have positions in. So one of the many interesting discussion points in our space in recent weeks has been the topic of potential dilution, or dilution versus concentration. So what I want to say is, imagine you have a portfolio where you're trading a smaller number of markets, whether that's 30, 40, 50, 60, something like that. And then you have a trader that follows trends on a portfolio of, say, 500 different markets or 600 different markets, something like that. So then naturally, if you have this big outlier trade happening, it has, in all likelihood, less of a footprint, less of an effect in the portfolio that trades all these, hundreds of markets, compared to the trader that has 40 markets in the portfolio. Did you ever look at that as kind of like, more like a bang for the buck, kind of like volatility, punchiness? You see my point, the positive skewness, the magnitude of the outlier return when it happens. If you reduced your holdings to, say, the top 50 or the top 40, and you really go for only the cream of the cream? Yeah, it's probably like my single most frequently asked question over the years is, can't you just get it down to a smaller universe? Like,
there you go.
Just you have all these stocks. Isn't that just diversification? And you're diluting your returns and all these other, kind of like natural things that people think. And, our approach is very much about maximizing the long-term geometric compounding of the strategy and minimizing the amount of dispersion of the lucky versus unlucky portfolios. So I'm trying to do something where I can assure myself that I don't ever miss those 4% winners, right? So if I trade everything, it's not possible for me to miss those moves because they weren't like the surest way to guarantee that you miss a move is to remove something from your tradable universe so that you never get the signal on it. So the concentration of the portfolio, what ends up, if you kind of think, oh, I created all these like random concentrated portfolios that were the top 50, right? Well, I could create like an infinite combination of top 50 portfolios that are going to have different names inside of it. Some of those portfolios are going to go on to just be super lucky and awesome, and you like own 50 winners that are just the best 50, and that's like the best killer portfolio, and it just crushes the more diversified kind of thing. But then there's a bunch of other ones that don't have any of those winners in it, and they radically underperform the diversified situation. So a concentrated portfolio is going to have tremendous amounts of lucky, unlucky portfolio performance dispersion. Whereas our approach that just has the whole universe in it, eliminates all of that dispersion, and is trying to just maximize its probability of success. It's not dissimilar of the logic of an index fund, kind of being diversified across everything versus concentrated managers. It's not that some of them won't work. They will, but many of them won't. And we just don't want to, we want to win in the end over the long term and win by not losing. And that means eliminating all of those unlucky portfolios. And we are willing to give up being lucky enough to be in first place with that one that just owns all the winners in order to have certainty that we're not going to have all of that unlucky portfolios part of what it is that we do. So it's a philosophy, kind of thing.
Yeah, good. You reduce the role of luck by trading all of them. I guess it leads to a smoother experience and a clearer extraction of the alpha that you have linked to your strategies. And then, but at any given point in time, you may then therefore be looking to underperform because, some of these moves happen in some like names and, compared to a trader that has a more concentrated portfolio, obviously that, shines through more heavily. And sometimes you look great because you don't have that much of a drawdown. You avoid some of these losing periods where the more concentrated portfolio gets hit harder. And I think this is what you've mentioned in the first part of your answer, also has this compounding effect. Like, by avoiding these larger drawdowns, which as one iteration of luck could happen, you reduce the chance of being down 50%, because when you're down 50%, you need to make 100 to come back up. And this is exactly the point where most say long only, I call them buy and hold equity investors. They don't even understand today what the pain would be like if they're down 50%. And every time they make one iota of a change to their S&P 500 allocation at that point in time, they will at that point decouple from the ensemble and very likely underperform the index going forward because of that action, that pain that was triggered. And not getting to that point actually is a lot of alpha in and by itself, I would say, which a lot of investors very easily overlook.
Yeah, well, there's two forms of alpha. There's the mathematical alpha of the benefits of low volatility reduction and controlling volatility. I mean, like variance drain, volatility gremlins, whatever you call them. I mean, there's a period where volatility becomes a volatility drag. So it is a real factor that directly mathematically impacts your rate of compounding over time. And like the optimal bet sizing versus over betting and the impacts that has on the decay of your compounding over time, right? So that's a huge factor, and that's explicit in how we think about stuff and the math that we have that engineers the portfolio and how we size things. The other side of it, is the behavioral part, that you talked about. And this is actually what's really important for our clients, and customers and their clients is if you can smooth the ride of investing, like investors don't like volatility, they don't like big drawdowns. It causes them to, feel fear, and then they sell and they make these behavioral choices that are counterproductive to long-term investment success because they don't like the experience of investing. And so our kind of approach is like, well, how can we make the experience of investing in the stock market better by reducing volatility, reducing the drawdown, reducing, these kinds of things that cause people to panic and do something and just have a smoother ride that also over time in the long term happens to be something that also optimizes your compounding. It doesn't solve one problem though, that you mentioned kind of before, the concentrated manager and somebody just killing it and they're, they've got all the right traits, in the portfolio and they just look awesome right now over the last 3 years. We're going to underperform, that person. So if you're kind of comparing the person who's in first place, it's like the tortoise and the hare, analogy, right? We're the tortoise just plodding along, compounding through time, doing our thing. And, sometimes the hare that's rushing ahead as the sprinter, looks awesome. But in the end, the little plodding tortoise compounds its way to having, more success because along the way, the hares they fall asleep, they do something, make a mistake, and they give up this head start, that they had. And so our approach is eliminating the unforced errors of those mistakes so that we can maximize long-term compounding. But that you still have human beings who reference the, and calibrate your performance versus somebody who's in first place. And, it's just, that's a real thing. And we just try to, work with people who prioritize the long-term compounding and kind of have these kind of, realistic expectation conversations around what your priorities are.
Yeah, well, all set. You mentioned earlier your correlation of about 0.55, I think you said, to the S&P 500. So if somebody comes to you and says, look, I'm 60-40 or I'm relatively US equity heavy already, would you say that your fund is a complement, like an addition to that portfolio? Or would you say, well, you could actually, reduce or even eliminate maybe your core beta 1, delta 1 holding and rather invest in your fund for a better experience? Or would you say, no, put the two together and you'll have a better basket?
So the definition of the word better, right? It's like beauty is in the eye of the beholder kind of thing. Really need to understand the client's needs, the client's constraints, the investor's needs, the investor's constraints to really answer what is quote unquote better, for somebody. In some cases, blending it, with other things is the right thing to do. For others who really don't want to have any downside risk of equity beta, replacing it, makes sense. What we spend our time doing is working on that. So when we work with financial advisors, we're kind of helping them construct the kind of the best alternatives portfolio that they can. But the definition of best, again, what's your goal? If you're trying to create a correlation zero alternatives portfolio, and that's your number one priority, our fund is not a fit for that. We're not going to be a correlation zero portfolio. You would need maybe you put managed futures together with gold and some kind of commodity trading, thing, and those three are going to give you correlation zero strategy. But the downside of a correlation zero strategy is that it's going to have a lot of tracking error relative to the stock market. So if you're a financial advisor and you sell your equities and you buy correlation zero, and correlation zero radically underperforms equities, your clients are going to be like, what is this thing? And why do I have it in my portfolio? And this just I don't like you and you're a bad financial advisor. The vice versa happens. Like if they put it in there and the market gets crushed and this is the diversifier, then you look like a hero, right? So, but it has this very lucky, unlucky binary kind of situation of whether or not, your clients love it or hate it. What we're trying to do is help financial advisors build durable portfolios that are kind of all weather in nature. And with my definition of all weather is like that you can hold it through different times, but it's more about like your clients will be happy with it. Like you're gonna be happy with the investment experience. So when we're in a raging bull market, you're not suffering massive amounts of envy, that you're just not making as much on the upside as everybody else is. But then when the markets get wrecked, you're not feeling like, oh, wow, I just got destroyed, and all of this stuff. You kind of just get something that's balanced down the middle. You're happy with it. And you're delivering more consistent investor satisfaction, with these things. And that's where you kind of have to mix and match the right ingredients, And so our portfolio and our strategy does a very good job of keeping up with the market while also hedging the downside risk. And so it's a great risk reducer kind of thing. But it's great to add into a portfolio of alts like managed futures where you have zero correlation. So it's a great diversifier, but it can have years and years and years of terrible results that just clients, like relative to the stock market, that people just hate. And so it's mixing these things together to kind of get something that delivers consistent investor satisfaction that we kind of focus on helping advisors with.
Perhaps a good way to wrap it up is like when you look back over the 20 plus years, what are some of the most important lessons that you have learned in this business or, while you have been doing this single stock trend following?
In the trend following, in general, I just think that sticking to your process and never deviating, kind of from it is more important than having the best process ever. I've seen a lot of people have good processes and they well-researched things. And then, there's short-term performance isn't there and they then monkey around with things or they cave to client pressure or other kinds of stuff and they change it. It's counterproductive. It doesn't work. So you have to marry, an effective process with the discipline to just continue to do it. And this is the area that I think just separates people who have success with this types of strategies and those who don't, is the ability to just have the temperament, stick to the process, continue to move forward, and the temperament to not quit or give up or change course based upon short-term feedback, that it didn't work is certainly, a big factor. Like we're all, just because you have a systematic process, you're still a human being and we still have to operate these things and do it. And it's like those who I've seen be successful over time are the ones that just didn't quit or deviate from, that what was otherwise a good process. It just was going through a short-term performance period that didn't give you positive feedback.
Speak about the role of luck, right? I mean, that's exactly the excursion. Well, you have to stick to your models and to your systems and just fight it through. It's painful, tough, but it works. Look, Cole, I think that's the perfect time to end it. Thank you for joining me today. I really liked it, and I hope our listeners will also. As ever, the most important thing for us is that our conversations stimulate some interesting thoughts or even aha effects. Maybe they lead to new ideas. So whatever it is, as long as it's valuable to you, we're happy. Cole, we'll put your contact details into the show notes. And please, listeners, if you have any questions, be that for me or for Cole, please don't be shy to email them to us. The email address is info@toptradersunplugged.com. We'll definitely pick them up and respond. So thanks for listening, and we'll hear you and see you next time on Open Interest.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.